So you want to learn how to make money by doing nothing. Well, luckily for you, there was a man by the name of Warren Buffett who achieved a 1,746% return by investing in a single stock in the late 80s using a handful of simple principles that can be applied to stocks today, and then doing absolutely nothing to it while it compounded and grew over 18 times in value. Oh, and I forgot to mention, it also pays him $670 million a year in cash dividends. Even if you already know what investment I'm going to be talking about in today's video, I went through hundreds of pages of annual reports to put this video together, so I guarantee you there's something in this video that you'll find interesting that you hadn't heard before. Now I know what you're thinking, Hamish, this is Warren Buffett we're talking about here. He is arguably the greatest investor of all time, amassing a wealth of over $115 billion. Of course, he could find such a great investment opportunity, but what makes you think that we could do the same? Well, today I'm probably going to blow your mind as I show you how relatively easy it would have been to identify this business as a great investment opportunity. In fact, the most difficult part of investing in this business in the late 80s would have been then sitting and doing nothing while it grew slowly over the following 3 decades. And since you clicked on this video, then my guess is you're probably pretty good at doing nothing. I mean, look at you right now. You're just watching a YouTube video, literally doing nothing. But in all seriousness, I recently have been going back over Warren Buffett's great investments to see if I can find any patterns between some of the great investments that he's made for Berkshire Hathaway or through Berkshire Hathaway over the past 50 years. And while many of his investments go right over my head and straight into the too hard basket, one of them stood out to me as being simple enough for almost anyone to spot. That investment was in the Coca Cola Company in 1988. So I dug into the SEC archives and read through 10 years of annual reports for Coca Cola from 1979 to 1988, the year Buffett invested about $1 billion into the company. And I did this because I really wanted to get into the mindset of someone looking at Coca Cola in the late 80s and looking back over the past 10 years of financials and annual reports from that point to really start to understand what Warren Buffett might have been thinking if he was looking at this business all the way back in the late 80s when he invested a significant amount of money into the stock. Just before we get into today's video, I do want to give a quick shout out to today's sponsor, which is SHARESIGHT, a portfolio tracking software that you can use to keep track of your stock portfolio gains, as well as track all kinds of things in regards to your performance of your portfolio, diversification, and when it comes to tax time. SHARESIGHT allows you to automatically bring in all of your past trades by connecting your broker, or you can do it manually or using Excel. And once you do, you will be able to accurately track all of the different types of gains that your portfolio will experience, including currency gains, which most people are not accurately tracking. SHARESIGHT gives you access to 12 different reports that can be used to track performance, as well as used when it comes to tax time. One of my favorites at the moment is the diversity report, which can of course be used to see how your portfolio breaks down in terms of different industries and sectors. But also for a value investor like myself, it allows me to get an insight into how much of my portfolio is concentrated in individual businesses. At the moment, you can try SHARESIGHT for free and track up to 10 holdings for as long as you want. So if you haven't tried SHARESIGHT, it's completely free. Go ahead and check it out. Also, if you want to sign up to a paid plan for more features, there's a starter, investor, and expert plan. And if you use my link, it's the first link in the description below, you will get 4 months off an annual subscription, which is a massive saving. But at the very least, go and check out the free plan and try it for as long as you want. Through the 80s, the Coca Cola Company was already a massive global operator. The company had been operating for almost 100 years and was selling over 200 billion servings of drink a year, generating the company over $8 billion in revenue in 1988. The business, which today is still relatively simple, was even more so back then. Their soft drink business, which primarily consisted of Coca-Cola, Sprite, and Fanta, generated 82% of the company's revenues, with the remaining 18% coming from their fruit juice brands such as Minute Maid. The Coca-Cola Company sourced its raw ingredients from around the world and created soft drink concentrates and syrups at company-owned facilities. Syrups and concentrates were then sold to bottling and canning companies who mixed the syrups with water to create ready-to-drink products for customers. But this wasn't always the way that the Coca-Cola Company operated. In fact, prior to 1986, the Coca Cola Company was heavily involved in the bottling and canning of their soft drink products. In 1979, for example, the company owned 14 bottling companies, each with a network of production and distribution facilities. But in 1981, a new management team led by Roberto Gozueta began doubling down on the primary driver of Coca-Cola's business, its trademarks. Coca-Cola was already the leading soft drink brand in the United States and other countries like Australia, but if they were going to replicate that success across the globe into many different countries, they were going to need to maintain a high level of consistency in their product and then effectively advertise that product to new markets. So in 1986, management moved all of their bottling companies into a subsidiary called Coca-Cola Enterprises and then sold 51% of it. This meant that management could focus on creating strong relationships with independent bottlers and running powerful marketing campaigns to embed the Coke brand in the consumer's mind. And speaking of strong relationships, if you're getting some value out of today's video, if you're enjoying this video, then it would mean the world to me if you could take a second and just hit that subscribe button. I really did read through 10 annual reports to do this video, and plus a bunch of other research and planning and editing that went into this video. So if you can take a second and hit subscribe, I would very much appreciate it. Now you might be thinking, everything that you're telling me so far, Hamish, is great, but what has this got to do with finding an 18x investment? Well, at the heart of every great investment, one where you can invest in a company and have to do very, very little work on that investment after that point, is understanding the business and the competitive landscape in which it operates. You see, we need to find a business that has a proven track record of continued success against competition, run by a skillful and honest management team, as well as a business that has significant opportunities to continue growing its revenues and profits into the future. And the only way that we can reasonably decipher some of these things is by knowing the business like the back of your hand. Fortunately for us, businesses like the Coca Cola Company are relatively simple to wrap our heads around. In 1988, the wholesale global soft drink market was about $14.5 billion, and the Coca Cola Company's market share was about 47%. That meant that by far they were the biggest soft drink company in the world, but more interestingly, the soft drink market in many countries was severely underdeveloped. So how hard would it have been for you in 1988 to figure out that there was a massive growth opportunity in front of the Coca Cola Company? Well, I mean, if you can read 11 pages, then you would have figured it out, because by page 11 in the 1988 annual report, you'd find the per capita consumption of the Coca Cola Company's products in major countries. You can see that the US already in 1988, the average person was consuming 289 8-ounce servings a year, with Mexico and Australia not too far behind. But then looking down the list, there are some major countries that have far lower consumption, the biggest standout being China. In 1988, China had a population of 1.1 billion, over 4 times the population of the US at the time. So a quick bit of mental maths would tell us that if China's consumption just reached half of that of the United States, then their China business would be double the size of their US business, and their overall business would be about 55% larger just on the back of China reaching half the level of consumption of the United States. In fact, if you extrapolate that idea to every country on this list, which is what I did, and assume that each reaches half the consumption of the United States, the company would be selling 400 billion servings a year, double the 1988 level. And there was pretty good reason in their annual reports over those 10 years to suggest that they were heading in that direction. The company describes the intense demand for Coca-Cola in China, where the bottling network was severely underdeveloped. They said, shopkeepers and street vendors jockey for Coca-Cola as it comes off the bottling lines. During the warm seasons, there is not enough product to satisfy demand. And it doesn't just stop there with anecdotal cases from different countries. The huge amount of demand for Coca-Cola products globally is also demonstrated in their consistent increases in unit volume. Unit volume growth reflects a percentage increase in the number of 8-ounce servings sold each year. Consistently high growth from this figure would indicate strong and increasing demand for their beverages. The graph shows continued moderate demand even during the 1980 to 83 recession, followed by an accelerating burst of demand coming out of that recession. If you take our earlier projection of 400 billion servings a year, and let's say they can try and hit that within 10 years, that would project 7% per year compounded growth in unit volume, which fits right in line with the 6 to 10% growth that they've been achieving in recent years. But units is only one side of the equation. We ought to think about the amount of money that they're able to sell those units for. Soft drink revenue in 1988 for Coca Cola was $6.8 billion, generated from about 200 billion 8-ounce servings, which means each serving was being sold at wholesale for about 3.5 cents. So like unit volume, should we have also expected that they were going to be able to consistently increase their prices per serving at wholesale? Well, if we actually go into the 2007 Berkshire Hathaway letter, Warren Buffett gives us a massive clue about how we should think about businesses that are able to raise their prices consistently over time. In the letter, Buffett was discussing their investment in See's Candy. He describes that over a 35-year period, the volume of chocolate sales at See's franchises increased from 16 million pounds to just 31 million pounds, only a 2% per year increase in volume. But also over that time, the company was able to increase the price per pound by over 6% per year, resulting in sales growing from 25 million in 1972 to 383 million in 2007. So how is this possible? How is it possible that they were able to achieve so much growth in revenue in what was basically a stagnant industry? 2% per year increases in the amount of volume of chocolate that Americans were consuming. Well, the answer is they have a wide economic moat. They had a powerful branding advantage, which meant that when they consistently increased their prices at 6% per year, customers were not switching and substituting See's Candy for competing products. In economics, this phenomenon is called price inelasticity of demand. If a product has price inelasticity of demand, then increases in price will result in higher revenues because price increases create more revenue than what is lost through lower volume. For example, if Coca-Cola sold 1 billion servings at 1 cent each, they'd be making $10 million of revenue. If they then increased their price to 2 cents and they were still able to sell 1 billion servings, revenue would now be $20 million and demand for their products would be considered inelastic. However, if they increased their price to 2 cents and they could only sell 400 million servings, then revenue would actually fall to $8 million and demand for their products would be considered elastic. Of course, in the real world, there are many other factors that influence the amount of volume and pricing. Just for example, as Coca-Cola expands into new markets, that of course is going to increase volume and has absolutely nothing to do with price elasticity or price inelasticity. But the idea here is that if the Coca Cola Company does have a powerful enough advantage, a powerful enough brand, then as they increase prices, customers will not substitute Coca-Cola for other soft drink brands that are available. And if they have that level of pricing power, if they have that wide, deep competitive advantage, then they will have a powerful and long runway to consistently increase prices at the wholesale level. So on top of our projection of unit volume growth of 7% per year, let's add another 5% per year for consistent price increases at the wholesale soft drink level. Plus, considering the manufacturing of concentrates and syrups is a fairly low capital intensive business, let's tack on another 3% per year growth for margin improvement. And if we use that assumption in my valuation spreadsheet, which is a free resource you can download via the link in the description below if you're interested, if we use that assumption in the spreadsheet and we also assume a steady 3% growth rate after the 10th year and that we're targeting a 15% return for our portfolio, the fair value of Coca-Cola in 1988 would have been around $50 per share. And with the stock price in the 30s that year, that gave Warren Buffett a margin of safety of about 25% to work with. Now, of course, in hindsight, those projections are extremely conservative. If we look at what Coca-Cola actually did in terms of unit volume increases, as well as in terms of price increases and margin improvement, they did a whole lot better than what we just projected. But even using those conservative metrics, which I think would have been reasonable given the information available at the time, we still got to a 25% margin of safety when targeting a 15% return. Now, as I said earlier, figuring out that this business at this price was a good investment is not the difficult part of investing in Coca-Cola and generating, and Warren Buffett generating such a massive return in it over time. What would have been difficult is buying it and then sitting on your hands for 30 years. One of the keys to Warren Buffett's success is that he bought pieces of businesses as if he was buying the entire thing, and that he had no interest in trading them frequently, buying them like you could imagine buying an investment property, that you're not planning on buying that investment property and then selling it and then buying it and then selling it 20 times during a year. That would be ridiculous. That would obviously incur massive costs and it would be stupid, but rather buying an investment property and doing what you should do with an investment property, which is sit on it for 30 years and collect rental income. Doing the exact same thing for great businesses is how you generate these massive long-term compounding returns. Now, as I mentioned earlier, this video took an enormous amount of research. So if you got some value out of it, if you enjoyed this video, if you're still here, I presume you probably enjoyed this video, then I would very much appreciate it if you could just hit the subscribe button. Just doing that takes you a second, doesn't harm you, it's fine. It's free if you didn't know. It's completely free to hit the subscribe button. Just doing that small act after watching a video or during a video is a huge help for my channel, so I very much appreciate it if you did get some value, but if you didn't, then that's fine. You don't have to hit subscribe. Make sure you check out SHARESIGHT if you do want to track your portfolio. Remember, the link down in the description below allows you to try SHARESIGHT for free, track up to 10 holdings, and you can also get 4 months off a yearly subscription if you want to sign up to a paid plan for more features. I highly recommend you check it out if you haven't already. But with that said, I hope you guys have a great day, and I'll see you in the next video.